Our first guest says the Fed will likely need to see 0.2% core PCE prints over the next few months in order to deliver an initial rate cut in June. Joining us now is Brett Ryan, Deutsche Bank senior U.S. economist. Brett, it is great to have you on the show. Maybe just our big picture, Brett. I'm interested to get your take on that CPI print, hotter than expected. What did you make of it, Brett? And what do you think the Fed made of it?
Yeah, sure. Thank you, Josh. And, as Jared said, I think, the Fed woke up this morning and wasn't too happy with the inflation print. As they've laid out the story from the March summary of economic projections, they really needed to see 20 basis points for the next two prints on core PCE to kind of justify starting that mid-cycle adjustment process without, seeing a deterioration in the labor market or growth. That kind of goes out the door with today's print. And I think it's not just about, can they go June versus July. The window was kind of small, somewhat small to begin with, because you're going to run into some difficult comps over the back half of the year in terms of year over year. And so, I think from the Fed's perspective, if they're not able to go in June, July, then you have to start thinking about, can they go at all this year? Or at least, sometime at the end of the year, like the November or December meetings. But without any sort of, without a clear indication of inflation moving back towards target, which today's data definitely do not speak to, with absent a labor market shock or something else on the growth front, it's hard to see significant rate cuts this year.
And on the flip side, Brett, you even have Larry Summers raising the specter of another rate hike. Do you think that is sort of out of the realm of possibility here?
I think the probabilities are still very much skewed towards cuts than hikes, as the minutes kind of showed. This afternoon, in the minutes from the March meeting, they were fairly confident that they'd reached the peak rate. I think it would take several more months of these type of data to bring the prospects of hikes back on the table. The Fed's not going to hike one more time. If they were going to hike, it would be for 50 basis points or more. And I think you would need about 6 months of bad inflation prints to sort of justify that.
And Brett, when you see these kind of inflation prints we're getting, though, I mean, a natural question would be, did the Fed not hike enough, Brett?
Yeah, so one of the interesting things about the March meeting was that there was a lack of discussion around the long-run neutral rate. You did see that rate come up slightly, just a tenth, in the March summary of economic projections. But, the market expectation is already well above the Fed. If you look at measures like 5-year forward, the market expectation for the longer run nominal rate is more like 3.5% or thereabouts. And so the Fed is sort of, behind the curve, if you will, in terms of admitting that, perhaps the longer run, neutral rate is significantly higher than where they currently have it penciled in.
The conventional wisdom has been that inflation not slowing down is reflecting strength in the economy. At what point does that run the risk of curdling to some extent, and the persistently higher prices that we've seen causing more damage to the U.S. economy, or just, sort of it seeing its own weakening regardless of where prices are going?
Well, I think the way to think about it is through, the growth rates, right? Inflation is not just a one-time step up in the level of prices, even though, many consumers certainly are annoyed that they haven't seen any declines in prices. And the inflation progress, to the extent that it's persistent, particularly in core services, is going to warrant a response from the Fed, may warrant a response from the Fed. And that response from the Fed is going to be, remember back in August of last year, when Powell was talking about the conditions the Fed needed to see to stop hiking rates. And those conditions were, labor market cooling and growth cooling. Well, we have strong growth, we have a strong labor market, and, rate cuts were on the board so long as inflation was improving. When that stops improving and clearly stops improving, or if we stall out here, it's going to warrant a monetary policy response, and that becomes a threat to growth.
Brad, I'll get you out of this. We got CPI, now we have PPI on deck. What are your expectations there?
Yeah, so the PPI, again, it's not about headline and core. It's really about those components that feed into the core PCE deflator. So one of the major ones we got today from CPI is the rental component, and that, of course, was still fairly strong. The main components that we're looking for tomorrow are healthcare services, as well as portfolio management. Now, healthcare services has one of the highest weights in the core PCE deflator. It's similar to that of rents. And when you talk about that super core number, what the Fed is really looking at is the PCE measure of super core, not necessarily the CPI one. And then portfolio management is one where that really it's predicated basically on a 1 month lag to equity price performance. So the fact that you had a strong equity price movement, in beginning of the year, you would argue for a fairly high print on portfolio management. And the Fed may look through that, given that the equity prices have come off recently. But the bottom line is that if you laid out this, narrative of core PCE inflation coming down to below 2.6%, your year-over-year rate in Q4, which is your forecast, you're not looking like you're going to hit that. With the prints that we have now, we're looking at right now on core PCE, which are more like 30 basis points. So tomorrow's data will round out our understanding of and add some precision to our core PCE forecast. But right now, it's looking like somewhere above 30 basis points.
Interesting. We'll keep a very close eye on it. And to your point about equity prices having come off, the S&P, for example, is only down about 2% from its high. So still not that much downside, all said and done. Brett, thank you so much. Great to see you.
Great. Thank you for having me on the program today, Julie and
Thanks.
Josh.
Thank you.